In progress.
Yeah, good day. Thank you for clicking on this video. You are, if you are new to Canadian income tax or you've been filing personal income tax in Canada, but you still don't understand the basics, the fundamentals of personal income tax, you are watching the right video. This video will explain the basics, the fundamentals, all the major tax credit and benefits you need to watch out for so that you can maximize your tax. Olushe Olowokere, a chartered accountant CPA, and I'm the founder of Accurate Consults. We provide accounting and tax services to small businesses. Yeah. So in this video, we're going to look at why personal income tax, who should file personal income tax, tax return, refund, and owing calculation. This is key. A major component of citizens of Canada don't understand how the refund is being calculated. So you need to understand what is driving returns in terms of deductions and credits, the major tax deductions and credits, and the popular tax needs. Why file personal income tax? Most general economies, the big G7, the large economies, generate a major percentage of their revenue from taxes. For example, in Canada, over 80% of its revenue is from taxes. And see that that's so huge. That's why the government is so serious about collecting taxes, putting in process to collect those taxes. And approximately 50% is from personal income tax. When you earn income, whether from salary or other sources, governments earn 50% of its revenue from personal income tax. That's why the government of Canada wants a lot of people to come into Canada so they can work, and when they work, they earn income so that government can make money to fund investment in infrastructure, to support marginalized and low-income earners, a lot of benefit, childcare benefits, Canada workers' benefits, a lot of benefits to low-income earners, of course, also to run the government to ensure that things are working as expected. Now, who should file personal income tax? Now, according to the tax law, if you reside in Canada in 2023 or you arrived on or before December 31st, 2023, if you arrived in Canada the last day of 2023, you are required to file personal income tax. If you're a citizen or a refugee or a permanent resident, or maybe you have a small businesses, sole proprietor, business owner, or you're an international student or other student that are above 18 years old. If you get to Canada, you arrive Canada on or before December 31st, 2023, you are required to file taxes. Now, of course, if you need to get a tax, if you want to pay tax, you're owing the government has not deducted enough from your personal salary or income, or you want a refund, or you want to transfer unused tuition fees. This for students, even if you do not work at all in 2023 in a given tax year, but you want to transfer unused tuition fees, tuition credit, then you need to file your tax so that those credits can be transferred to future years that can be used when you earn income. Now, there's also the scenario of reportable income versus taxable income. Now, a reportable income is income that you are required to report, but you won't pay tax on such income. Now, looking at these different scenarios, let's assume someone arrived Canada in 2023, in September 1st, 2023, Now, before arrival, the period in 2023 is January 1st to August 31st. Now you are supposed to report the income. So let's assume you move from UK to Canada or from Ghana to Canada in 2023, and you got to Canada September 1st. Now the income you earn while living in Ghana between January 1st to August 31st is a reportable income. You are supposed to report that income, the figure, in Canadian dollars, but you only tax on that amount. So that's why it's reportable and it's not taxable. Now, of course, if you arrive before 2023, this is not applicable to you. You are supposed to report your worldwide income. Now, we have a scenario whereby some people, they earn in Canada, they also earn in Ghana. So you are required to report your worldwide income, and the worldwide income is taxable. So the income you made in Ghana, the income you earn in Nigeria, the income you earn in Canada in 2023, if you are living in Canada in 2023, then the worldwide income is taxable. Going back to this first scenario, so someone that got to Canada September 1st, 2023, so you're a resident of Canada from September 1st to December 2023. If you earn income in other country, maybe in October or November, that is a taxable income. That means that your worldwide income is taxable. As when you become a resident, your worldwide income is taxable. So from October, the income you made if you still make any income in Nigeria, that income is taxable. If you make any income in Canada, that income is taxable because as of September 1st, you became a resident, and any resident of Canada and any income you made from September 1st to December 31st, 2023 is reportable and taxable when you become a resident, your worldwide income. Now, if you're married and your spouse is maybe still living in Ghana or Nigeria, you're supposed to report the income because that information is needed to calculate some tax credits. Although it's not taxable, but let's assume your spouse is still in Nigeria, where you're supposed to report the income your spouse made in the entire 2023, but it will not be taxable. So you need to have that information available. Now, this is the fundamentals. A lot of people struggle with this. You need to understand how refund, owing, or balance or refund is being calculated. You need to understand how these numbers are being derived, being computed. So I tell you, if you give the same information to two different tax preparers, the same information, they should arrive at the same number because this is mathematics, basic calculation. So if the two tax preparers not arrive at the same number, it's either one of them is wrong or both of them, they're wrong. They should get the same answers because it's calculation. So you need to understand how this is derived. Now we start from your personal total income. The makeup of your total income is your salary income. If you work either full-time or part-time, other income you earn, commission, tips, self-employment, net profit. Now we say net profit. Now, self-employment income will be added to your personal income tax. When you file your personal income tax, any income from self-employment in the sense that either you're a sole proprietor, either registered or not. So if you have a registered sole proprietor, under the tax law, you fall under self-employment. If you have any unregistered business, you still fall under a self-employment income category. If you have an incorporated business, a corporate business, you're going to file a separate tax for the corporate entity because it's a separate entity. So the net profit means that the income from that business minus the expenses, your revenue minus expenses. So it's the net of that profit that will be added to your personal income tax. then other income. As Ella said, tips, any other income. We're still going to go through the list of, so that is your total income. Now, after your total income, we get to tax deductions. Less tax deductions, we get your net income. Then from your net income plus other income, we get the taxable income. This is the main driver, your taxable income. The lower your taxable income, the lower the tax you're going to pay, the higher your refund. So the goal is to reduce your taxable income to the barest minimum legally, reduce it to the barest minimum. Now, from this taxable income, the federal, you pay federal tax and provincial tax. So let's assume your taxable income is 60K. Now, federal tax, the first 53,359 will be charged at 15%. Plus, so let's assume you earn 60K, 60K minus 53,359. Let's assume you earn 50K. First, let's assume your taxable income is 50,000, 15% of 50K. That will be your federal taxable income. But let's assume you earn 60K. The first 53,359 will be charged at 15%, plus the remaining 6,641 will be charged at 20.5%. So the higher you earn, if your taxable income is more than this, the remaining one will be at this, at this. Consider the higher you earn, the higher your taxable income. So imagine 33%, a third of your taxable income, the government is collecting it. That's why you need to look for right way, legal ways to reduce this taxable income. Now, let's assume you reside in Ontario. That's the federal. On this same taxable income, you can see federal tax payable, the rate on your tax times of the federal tax rate. So let's assume you live in Ontario. Ontario too will collect its own tax. So on this taxable income, you compute the federal tax, then you compute your provincial tax. So for Ontario, let's assume your income is less than 49,231, you just pay 5.0.5%. Or if your taxable income is more than that, the remaining will be charged at maybe 9.5% as your income increase. You can see even the lower earning person in Canada or in Ontario pays an average of 15 plus 5.05%, which is over 20%. 1/5 of your taxable income, Government of Canada collects as taxes. So it's like, if you're not very careful, if you don't look for ways of reducing your taxes in a legal way, you're just working for the government. So this is federal tax plus provincial tax on your taxable income to get your total tax payable. Then this is where the other deductions come in. Your total federal non-refundable tax credits at 15%. For federal, the non-refundable tax credit is at 15%. So all the tax benefits that are non-refundable, we're going to look at the makeup of these non-refundable tax credits. Federal will give you some tax credit. Also, the province also have non-refundable tax credit at the different provincial rates. The rate for Alberta is different from Ontario. So the addition of the two will reduce your total tax payable to get this amount. Also, then less refundable tax credits for federal and for province. You can see the difference between the two. There's what they call non-refundable, and this is refundable. We're going to look at the difference between the two in subsequent slides. So your total tax payable minus all the refundable, less the refundable tax credit and non-refundable tax credits will give net tax payable. Now, this is the net tax payable. Now, this will not be compared with the tax you have paid at source from your salary income. Your employer removed federal tax from it. When maybe you withdraw RSP, they charge income tax on it. when you did the transaction, they charge income tax. All the summation of all the taxes that have been deducted from your salary and other sources will now be compared with this. So let's assume your total net tax payable is 10K, and the total tax paid at source is 11K. So 11K is more than 10K. The federal and province is saying your net tax is 10K, but 11K has been deducted from you at sources, at various different sources. So 11K, because what you have paid is more than what you should have paid based on federal and province calculation. What you have paid is 11K. What you should have paid is 10K. 11 minus 10K, you get a refund of 1K. But let's assume the net tax payable is 12K and you have paid 11K as source. It means that what you have paid as source is not sufficient. The government will ask to pay the remaining 1K. In that case, you'll be owing the government. So that's the basis of how your refund or owing is being calculated. In subsequent slide, we're going to look at all these, the makeup of total income, other income tax deductions, the provision tax credits, and the likes. Now, this is your total income. As Elia said, your total income, this total income components, all these, the sum of all these to get your total income is either from your salary income, when you make commission, when you sell product and you earn commission, you'll be taxed. When you're out of job or you're on maternity and you get insurance and other benefit from government, that will be taxed. If you drive Uber, you're giving tips, or you work in a restaurant, you earn tips, you'll be taxed on such tips. If you have investment assets like bonds or GIC and you earn interest income, you'll be taxed on it. If you have dividend, maybe you have stock of Amazon and you earn dividend, you'll be taxed on the dividend you earn. If you own a property, either a rental property or a short rental like Airbnb, you'll pay income tax on that, on the net profit from that business. Now, if you sell your property or you sell an asset, you'll be charged on 50% capital gain on that asset. Also, let's assume you have a car and you want to buy a new car. You sell that car. And you make income on that car. The income on that car is taxable. The net profit from that car, if you earn any income. That means the selling price is more than the cost of that car. You'll be taxed. Anything you sell and you make income on it, you'll be taxed. Support payment received for people that have maybe in relationship and maybe married or common law, and they are divorced and their spouse is expected to give them money monthly based on maybe the kids to support the family. That support payment received from your spouse is taxable. Taxable scholarship. Ideally, when you get scholarship or bursary, it's not taxable, but there are some scholarships that are taxable. Some portion are taxable, depends on the nature of scholarship. Also, for example, if you get grant or scholarship to go to school, maybe go for a postgraduate program, and you not go to school, then the government will tax you on that because you do not attend the school, so you do not qualify for the scholarship. Self-employment income, as earlier said, if you own a business, self-employment income, either registered or unregistered, supervisor, the net profit from that business, income minus expense, is taxable. Moving to subsequent slides. Yeah, so we are going to total income less deductions to give you net income. How the net income is being calculated, the makeup of tax deductions. These are the major component of tax deductions that you need to know. So registered pension plan, if your employer contributes to RPP, and also you're required to contribute. Your own contribution is deductible. It can be used to reduce your taxable income. Registered retirement savings plan. This is also a private retirement savings plan so that you can save towards retirement. Any contribution in the tax year will be deductible. First home savings account. Now, this was recently introduced last year by the government for people that want to save for their first home. Now, before now, you can use your RSP to save for your first home, and you can withdraw the amount to pay for your down payment. So government is saying they want to separate it. So this first home savings account has the features of both RSP and tax-free savings accounts. So it means that the income you earn, the interest on your savings account that you earn from the bank is not taxable. But you can, instead of using your RSP to save for your first home, for your down payment, you can use first home savings account. So any contribution into this account will be used to reduce your taxable income in a tax year. Also, like I'm a chartered accountant, I pay CPA dues every year. I can claim these. If you're an HR professional, you pay CPA due, you pay dues, you can. Now, those deals in question must relate to your job. Some people, they pay PMP, professional dues, but what they're doing, maybe they are working as a factory worker and you're paying PMP. You can't claim that because it's not relevant to the current job, the jobs you did in 2020 in the tax year. So it must be relevant. There must be a relationship between what you're claiming and your job role. Childcare expenses. So the government is trying to encourage people to work. You can take your child to daycare or childcare centers. You can claim all these expenses, either for childcare expenses or daycare or daycare or after school program that you enrolled your child for. Now, if you enroll your child for swimming lesson, for soccer lesson, for taekwondo lessons, or any form of game, basketball lessons, they are not applicable. They are not applicable for childcare expenses. They are only applicable if it relates to summer camp. During summer period, maybe you enroll them for soccer or basketball or any game during summer. But outside summer period, the regular day-to-day activity or week-to-week activities, you can't claim childcare expenses. Disability support deduction for people that are disabled or they have one infirmities or the other, maybe people that use wheelchair, people that have, and they are approved by CRA. Your medical doctor will sign on it, you send the document to CRA will approve it, then you will be allowed to claim these deductions on your taxes every year. Moving expenses is only applicable if you move for school purpose. So let's assume I live in Ontario and I want to start a master program in Alberta. I have to relocate to Alberta. I can claim this. Or I live in Kitchener and I have a new job in Toronto. I need to move more than the distance between I'm moving closer to my place of work by 40 kilometers. If it's not up to 40 kilometers, you can't claim it. So you can only claim moving expenses if you are moving because of school or you're moving because of a new job you got and the distance between your former place, your office and the new place and closer to your office by 40 kilometers, moving closer to your office by 40 kilometers, you can claim this. Support payments made. So as earlier explained, for maybe divorce or separated couple, if you are paying, supporting your spouse, the amount you're paying monthly in a year, you can claim it. Carrying charges or interest expenses. So if you have investment, the government is trying to encourage people to invest, to make money. So let's assume I want to invest in Amazon stocks and I don't have money. I can go to my bank, borrow $50,000 to invest in Amazon stock. Now, what is applicable here is that the interest I'm charged by the bank, by the lender, I can claim it to reduce the dividend income I earn from Amazon. So the dividend income less the interest expense. So the interest expense on such investment, borrowing to invest, I can claim such. Then other employment expenses, your work from home expenses, your detailed work from home expenses. If you work as a sales rep and your employer gives you the permission to claim traveling expenses, your gas, and other expenses, you must get a document from your employer to be able to claim this, and is a major source of tax deduction. So we are done with all the tax deductions. We'll move to the plus other income before we arrive at our taxable income. Yeah, these are the other income that will be added to your net income to get your taxable income. Now, capital gains, deductions, this will reduce your net income, but it's been added back to get at your taxable income. So you sell a property, the gain you make on it reduce your taxable income, but be added back. Security options. So if you work for a company and you're giving options to buy at a lower price, to buy the stock price of the company at a lower price, is you get deductions, but this deduction will be added back. Non-capital losses that has been removed from your net income will be added back. Now, people that live in the northern part, maybe northern Ontario or northern part of BC or the West Coast, they get some deductions to reduce. Government just want to encourage them, support them for staying in those remote locations. They can use such to reduce the taxable income, and that will be added back to get the almighty taxable income. Now, and we have explained how your taxable income is being computed. Now, let's look at the non-refundable tax credit. A long list, but from the word refundable, it means that if your tax payable is not sufficient, you can't claim this. You won't be able to claim it. Like, so let's assume my tax payable has been reduced to 0. And I've reduced all my taxes to 0. And I maybe have not claimed let's assume I've not claimed home buyer's amount, maybe like worth of $750. I've not claimed it. Non-refundable in the sense that because my tax payable has been reduced to 0, that amount, I can't enjoy any other benefits. It's not refundable to me. So it will just, my tax payable will be 0, but government will not repay me. I won't get a refund on additional expenses that I've not claimed, like maybe home buyer's amount, medical expenses, because my tax payable is already reduced to 0. It means that it cannot be refunded. If I don't have my tax payable is not sufficient enough to cover it, it cannot be refunded. Compared to refundable tax credit, even if my tax payable is 0, if I have a refundable tax credit of like $500, the $500 will be added to my 0 to get $500 maybe tax refund. But for non-refundable, it's not refundable if you don't have a sufficient tax payable to accommodate that tax credit. Now, everyone that works in Canada that is married or in common law, get a spouse or common law partner amount as a tax credit. But if your spouse is working and earns more than the minimum amount, you get 0. The whole essence supports family with low income. Eligible dependent amount. For people that don't have a spouse and they're divorced, or they have a single parent, they can claim eligible dependent a dependent depending on them. Caregiver amounts. If you have someone that is sick, that is infirmed, like disabled, and you're supporting the spouse or your child, can claim additional caregiver amount. Medical expenses. Yes, medical expenses. It's not all medical expenses that can be claimed for tax purpose. It must be prescribed drugs. So if you walk into Shoppers Drug Mart and get Tylenol or Bandage, you can't claim all such. It must be prescribed by either a doctor at the walk-in clinic or by your family doctor. Prescribed drugs, not just any medical expenses. Then maybe you have a surgery or you any medical expenses that is being administered by a medical professional to the limit of 3% of your net income. Now, let's assume our family net income, let's assume my net income is 60K. 3% of 60K is, I think, is 3,000. So what I'm saying is that if in a year I don't have if my medical expense is up to $3,000, I can't claim anything. The real essence of the medical expense tax credit is to support low-income family earners. So if my income is $60,000 and 3% of 60,000 is 3K, or maybe 2K, 3% of 60K is 2K, and my medical expenses is not up to 2K in a year, then it means that it's lower than 2K, I can't claim anything. But someone that has a net income of, let's assume, 20K, 30% of that is $200. So the person can claim any medical expenses that is above $200. So the whole essence of this is to support low-income earners. So 3% threshold must be met before you can enjoy medical expense benefits. Donations and gifts. If you donate to religious organizations, to NGOs, to churches, to mosques and other religious organizations, or to non-for-profit, you can claim a tax credit. If anyone that is disabled or for self or dependent, you can claim disability amount, home buyers amount, as earlier mentioned. If you get your first home in 2023 in a tax year, you can claim the home buyer's amount. Tuition credit, international students, high school students, you can claim your tuition credit on the school fees. If you do not work, if you do not earn any income in that year, you won't be able to get your refund, but your credit can be carried forward to future years while you work. So it's advisable for you to file your tax as an international student so that you can carry forward your tuition credit. Because ideally, even if you did not file, but if your employer did not send the school did not send your tax slip to CRA, CRA is not on CRA system. Next year, when you file your taxes, your tax accountant or the software, that software might not be able to determine or locate your tuition credit, might not have that record. So it's advisable, even if you do not earn any income, make sure you file your taxes. Then for those that have OSAP or student loan, interest you paid on such loan is a tax credit that can be used to reduce your taxable income. Digital news subscription expenses. The government is trying to encourage digital subscription to news instead of paper subscriptions. So you can, if you have subscribed to like Bloomberg News, you can use this to reduce your taxable income. Home accessible expenses, people that are disabled or the seniors, the aged ones. Let's assume you install a lift in your home or you make your home more accessible. The expenses can be claimed up to a limit. Now, adoption expenses. If you adopt a child from Bahamas or from Africa, you can claim the expense to a limit of, I think, $15,000. Then following federal tax credit. So for those that work partially in the tax year, maybe in Nigeria or Ghana, and you have paid tax in Nigeria, so there is a mutual agreement between Canadian government and Nigerian government, or most government of other countries, so that you don't have to pay tax twice in both countries. So there's what they call federal tax credit. So you're supposed to declare the income you earn in that country, and that record will show the tax you have paid in that country, and you get a foreign tax credit that can be used to reduce. So we are at non-refundable tax credits. As we have this credit federal, we also have a list of provincial tax credit. Most of these are replicable, available in the province too, but at different tax rates. So less federal non-refundable tax credit at 15%. So the total of your non-refundable tax credit, the total times 15% will be used to reduce your tax payable. Also, similarly, provincial non-refundable tax credit, the total will be used to reduce times the given tax rate. I know some provinces 10%, some is 5%, we used to reduce to get this year before we now move to the federal refundable tax credits. Now, as I explained, they are refundable. So even if your tax rate is zero, government will still will refund you. Now, the non-refundable tax credit, Canada training credit. Now, if you attend a training, let's assume, attend a CPA training in the tax year, you can claim that training cost as a refundable. I think is it $125 per year? Yeah. But the training must be conducted by a recognized Canadian institution. So PMP is not recognized Canadian institution. So you can't claim such under this Canada training credits. Let's assume you attend Conestoga or you did a short course by a Canadian institution, and you can claim it. Multi-generational home renovation tax credit. This was introduced in 2023 because of the shortage in rental homes. Government is trying to encourage people to renovate their homes to accommodate their loved ones. Now, let's assume my parents lives in Canada. I can renovate my house, renovate my basement, or maybe the upper level, so that my parents can live with me. That's why they say it's multi-generational. For parents, grandchildren, or grandparents, seniors, or disabled. Now, for you to claim this, the home must have a private entrance, a private kitchen, a private washroom. So if you accommodate your parents in maybe the upper level, the same level, one of the rooms in upper level, that will not have a private entrance or a private bedroom or a private washroom. So that's not applicable. So it's either maybe you have a basement, you complete your basement or refurbish your basement so that your sibling, your parents or your related senior can live in, or you have a big compound, you constructed a semi-detached beside your property, you can claim it. Canada Workers Benefits support low-income workers. Now, for you to claim this, none of the spouse must be attending school full-time. Maybe they might be attending school part-time, and the total income of the family is low. Then you can claim this Canada Workers Benefit. Then eligible educator school supply. So for teachers, let's assume I'm a teacher. I spent money to buy cardboard, a pen for my students. And the school where I teach, I'm not refunded. When I file my taxes, I can claim all these and I'll get the full value of my expenses. So we are at refundable tax credits. So both federal and province has their own refundable tax credits. This minus this, they will now arrive at the net tax payable. Now, the net tax payable will now be compared with the total income tax I've paid at source from your salary income that has been deducted from your salary, from other sources. That will be compared. If this is more than this, it means that what the government says you should pay is more than what you have paid. You are owing the government. If what the government says you should pay is lower than what you have paid, it means that you have overpaid. You get a refund. So it's a calculation. A lot of people tell me that, oh, my friend, we are both of us are international students. He got a refund of 2,000 and I'm getting $500. Your situation is different. This is calculation. As long as the tax preparer capture the right information, you will get the right answer. Now, moving on to the popular tax I've gotten a lot of information or email from, especially from students or newcomers. Can I claim my rent? Yes, rental tax credit is available in Ontario and BC and some other provinces. It's not all provinces, but this will not affect your refund or balance owing. It's a credit that will come through other means that government will pay you if you qualify, if your family has a low income. If the family income, net income is more than 50K, even if you impute it, you won't get any benefit from this. The whole essence is to support low earning families. So, but it will not affect your balance refund or owing in your tax return. So just like your GST credit, they will pay it subsequently. Gas expenses. Can I claim my gas expenses? No, except you use the vehicle for business, either for your sole proprietor business or your incorporated business. Then you can use that to reduce your business taxable income. Can you claim your groceries expense? No, except you have a food business and are using part of your groceries as inventory for cooking. Of course, cost of cooking will be used to reduce the business taxable income. Students get refund on their tuition. You only get a refund if you work. And based on your total tax payable compared to your amount of tax you have paid as source. If your tax payable is more than what you have paid as source, you owe government, even though you have tuition, you pay tuition fee. So it depends on your tax situation. So you won't get a refund because you went to school. Even if you attended school and you not earn any tax at all, there won't be any tax deducted as source. You won't be able to get a refund. The best scenario is your tuition credits will be carried forward to subsequent years when you earn employment income. I earn less than 10,000, so do I need to file a tax return? Even if you earn zero, you don't earn any income in that year, it's always advisable to file tax return so I can get other benefit like maybe child care, child benefit, or climate action benefit, or GST credit, other credits. So it's advisable file your return even if you don't earn any income in that tax year. These are not considered income. Anything is taxable in this country. The only thing that is not taxable is if you win a lottery. Even for people that are late, whenever someone passes away, government will now reevaluate the situation of that late person to see, oh, does this person have some unrealized taxes or gains that have not been charged? They will calculate and determine before and send a notice to the family. This person has a final tax and needs to pay this money. So if you need to sell maybe dispose properties of the person before so that you can pay final tax. In Canada, even any amount you make, you pay tax on it. If I work abroad, I don't need to file tax. As Ella said, worldwide income. If you're a resident of Canada, based on the tax law, and in a tax year, maybe you travel to Nigeria to work and you want to file your tax, you need to file the tax record, either as a deemed resident or not. Filing taxes is voluntary. As earlier said, is mandatory for you to file your taxes. For international students or for PR, when you want to file for citizenship, they will ask you to show record of the taxes you filed within the last 3 years or last 5 years as applicable. So please file your taxes. Students don't have to file to pay taxes. If you need to file your tax, and you need to pay your tax if you are owing the government. Mortgage interest is a tax deduction. Just like rent is only a tax deduction if you run a business from home. If you don't run a business from home, you can't claim your mortgage interest deduction. Money made online is tax free. If you are involved in cryptocurrencies or you buy and sell online, any income you make is taxable. If you don't declare it and the government gets to know, you'll be penalized. So please ensure you report all income as required. Maternity leave income is not taxable. Just as earlier said, the employment insurance benefit you earn when you're on maternity leave is taxable, is an income, and government will what? Tax it. The only thing that is not taxable, one of the things that is not taxable is child benefits, or government supports families monthly, paying them child benefit. That is not taxable. Yes. So if you want to learn more, you can put a comment on this video. If you need guidance on set up an incorporated business, you want to file corporate income tax, or you need an expert to help with your personal income tax, you want to file GST filing for your business, or you want to incorporate a business, you want to set up payroll service for your employees, we can help you set up an automated system that will debit your business account, credit your staff, and also remit CPP deductions, ER deductions, income tax deductions to self. You don't need to manually send any document to CRA at the end of the month or quarter. We can help you with business plan writing, consulting, and advisory, preparation of financial statement, and next. We'd like to hear from you. Our advice, you click the subscription button so that in case you get alert, so that you can get alert for our next video. Thank you so much for joining. I would like your comments on this video. Take care, and I wish you a fruitful and prosperous stay in Canada. Please ensure you file your tax every now and then. Bye for now.